In this video, we're going to calculate the labor rate variance and the labor efficiency variance. And both of those are basically, it's your labor price variance and your labor quantity variance, but those are the proper terms for those two variances when you're talking about labor. So I still have this general diagram here, our multi-purpose diagram to find all of our different price and quantity variances. The only difference, and you don't really have to change this, but this is really keeping it as technically accurate as possible. When we're talking about actual quantity of something like labor or even variable overhead, it's still actual quantity, but to be more specific, we refer to it as actual hours. So that's why you'll see AH here. And instead of talking about actual price, a more specific and accurate term would be actual rate when you're talking about labor or overhead. So that's why on the diagram to the right here, AQ is instead AH, AP is instead AR, and then SP is then SR. But again, you can use these regular ones that we did. No problem with that. But just so you know, when you see this, it's referring to the same thing. We've just plugged in the word hours for quantity and the word rate for price instead. Okay, we're still working on Glacier Peak Outfitters, and it has the following direct labor standard for its mountain parka. So 1.2 standard hours per parka at $10 per hour. So what this is saying is that based on standards, we should be using 1.2 hours of direct labor to make one parka, and our standard wage rate should be about $10 per hour. And I'll just keep in mind when you see these standard rates for labor, that isn't just the hourly rate that the workers are being paid. That $10 is an average of all of the different workers, because remember, your different workers might be paid at different rates based on how long they've been with the company or their expertise or what kind of position they hold. So first off, that $10 per hour is an average for all those direct laborers. Second of all, that $10 per hour isn't just the base pay, the hourly pay. It also includes those fringe benefits. So anything that's part of those workers' compensation will be added in to get to that $10. So that's overall what we're having to pay those workers for every single hour of work. Okay? So here it says last month, employees actually worked 2,500 hours at a total labor cost of $26,250 to make 2,000 parkas. Okay, so we know what our actual wage cost was to make those 2,000 parkas in terms of the direct labor cost. So the first thing we want to really do so we can fill out the whole diagram is to find our SH or SQ from the previous problem, or the standard hours allowed for the actual level of activity. So knowing that we actually made 2,000 parkas, how many direct labor hours should we have used based on standards to make those 2,000 parkas? Well, they tell us up here that we should be using 1.2 standard hours per parka. Well, if we made 2,000, we're going to take those 2,000 parkas times 1.2 direct labor hours based on the standard. So we should have used 2,400 hours to make those 2,000 parkas. So let's first find our labor rate variance, where we compare what we actually paid for each hour versus what we should have paid for each hour. So they first give us the total amount paid here. So they told us we spent $26,250 on the 2,500 hours. So I put that $26,250 there first, and then I worked backwards a little bit to find out what they actually ended up spending per hour. So they actually used 2,500 hours. We're going to take that total labor cost of $26,250 and divide that by the 2,500 hours to see that on average they were paying about $10.50 for every direct labor hour. Now, how much should we have been paying per hour? About $10 per hour with all compensation costs included. So it looks like here we paid 50 cents more per hour than we should have. So remember, to find the rate variance or the price variance, essentially, you're just comparing the rate or the price based on the actual amount of the input. So here it's hours. So the actual hours of 2,500, we paid $10.50 per hour when we only should have paid $10 per hour. So when you compare the $26,250 to the $25,000 that we should have paid, we got that by taking the 2,500 direct labor hours times the standard wage rate of $10 an hour. We got 25,000. When you compare that to what we actually paid, the 26,250, we can see there's a difference there of 1,250. Now, why is that unfavorable? Well, that's unfavorable because we spent more than we should have on the actual amount of direct labor hours used. We spent 50 cents more per hour than we should have. So anytime you spend more than you should have, it leads to an unfavorable price variance, or more specifically here, when talking about labor, an unfavorable labor rate variance. Now, let's find the labor efficiency variance. So here's where we compare how many hours we used to how many hours we should have used. So remember here, the difference is the number of hours we use in that calculation. We're going to use the standard rate in both of these calculations because we're only focused on the difference in hours, not the difference in rate. Otherwise, if we were to use the actual rate or the actual price in these right-hand calculations, then we're mixing up these various amounts, and then we won't get such a clear view on what the actual quantity variance is here. So that's why we use standard rate or standard price on the right-hand side. So we already have the middle filled out where we look at what we should have paid for the actual hours we used. So we used 2,500 hours. How many hours should we have used? We should have used 2,400 hours. So we found that 2,400 hours by this calculation here, right, where we found how many hours should we have used to make those 2,000 parkas. And we got that by taking the 1.2 hours we should be using per parka times the 2,000 parkas we made. So 2,000 times 1.2 is 2,400 hours. So we should have used 2,400 hours. So we can see here we used 100 more hours than we should have, right? So that's 100-hour unfavorable variance on the surface, right? Because anytime you use more than you should have, that's an unfavorable quantity, or in this case, an efficiency variance. So when you compare that 25,000 to the 24,000, we can see there's a difference of $1,000 there, and it's unfavorable because we used more hours than we should have. Now, some of you might be wondering, why are we even converting it to dollars if I can already see that there's a 100-hour unfavorable quantity variance there? Well, when we look at financial data and we look at even financial statements, all of those are in dollars, right? Anytime we look at budgets, we always come down to a dollar amount. So we don't just stop at the hourly figure, but we have to convert that to dollars for ease of comparison. So that's why we do all of these, convert these variances to dollar amounts. All right, so we have an unfavorable rate variance, labor rate variance of $1,250, and an unfavorable quantity variance of 1,000. When you combine these, we can see both of them are unfavorable, so that leads to an overall larger spending variance of 2,250. And it's unfavorable because both of them are unfavorable. So our spending variance in terms of direct labor is $2,250. So again, this diagram is a great way to calculate these variances, but as you get more comfortable, you can use the shortened formula methods for this, just as an example, just to illustrate. So the labor rate variance, just to show you, and you can see this in the PowerPoint in the book, I can take those two variances, for example, I know it's the AH times the AR minus the AH times the SR. So that's the formula version. Or then I can take out that common component there, which happens to be AH. So I can take that AH times the AR minus SR. So that's the other way that you can find the labor rate variance. And with the labor efficiency variance, again, it would be that middle portion, the AH times the SR minus the SH times the SR, and we can shorten that if we wanted to pull out that common SR and multiply that by the difference between the actual hours and the standard hours there. So that's the formula methods that I was talking about, where if you once you understand this diagram and you're comfortable with finding and labeling those variances, you can really come down to a point where you're actually just using these shortened versions of those formulas.